Welcome to Night It's Aboard. This is the Financial Contrast series, a series where we contrast important options you will face in your financial journey. Stay tuned for the pros and cons of each option. We'll provide a framework to help you choose the best option for yourself. In this episode, we're going to look at credit versus cash. The scenarios will just get you thinking, and they may not necessarily be all encompassing, but you can add as many factors as you want. The first scenario, we're going to look at buying a car worth 300,000 cash versus buying it on credit. Now, if you pay cash, you pay the sticker price, which is 300,000. No interest, no monthly payments, you immediately own the car outright. However, that's 300,000 of your cash gone. On the other hand, the car will depreciate. The second option will be to buy on credit. Let's assume the loan term is 5 years and the interest rate is fixed at 12%. You're going to not pay a deposit, so we're simplifying this, and the monthly payment you're going to look at is about 6,670. The total that's going to be paid over 5 years is going to be 400,200. That's a total of interest of 100,200. Paying 300k versus 400.2k, you choose. The second scenario is buying a house 600,000 cash versus buying it on credit. Now, when you pay cash, the purchase price is 600,000, no mortgage interest, you own the house immediately, but all your cash is tied up in one asset. If house's values rise, great, but if you need liquidity, it's not easily accessible. The second option would be to buy on credit, get a mortgage. So let's assume the term is 20 years, the interest rate is 10% per year, and we're going to assume the interest rate is fixed. And let's also assume you're going to pay a deposit of 10%, which is 60,000. So your monthly payment, you're going to pay about 5,210. So the total paid over 20 years is going to be 1,250,400. So the total interest paid is 710,400. So you actually pay more than double the borrowed amount, and that's due to interest. However, you still, if you had the cash, can keep the 540,000 and maybe invest it or stay liquid if you had the cash. Now, you build equity in a growing asset. Generally, property does appreciate. You benefit from leverage where you use the bank's money to own an asset that could increase in value over time. Paying 600k versus 1.250 million, the choice is yours. Now let's look at another scenario. Buying on credit for 200k at 8% interest over 5 years versus saving to buy. You save at 4%, the inflation are going to peg it at 6%, and we're going to exclude the cost of ownership for simplicity or the difference in commuting versus cost of driving. Now, if person A is going to save to buy later on cash, their monthly saving is going to be about 4,055. And the time horizon they're going to need to raise money 6 months. Why? Because they're saving at 4%, and we are factoring an inflation of 6%. So the new price is going to be approximately 271 at the end of the period. Now, the car is most likely going to cost more in nominal terms due to inflation compared to buying it now. The second person opts to buy the car now and is buying on credit. So the interest rate you're going to use for this scenario is 8%, and the loan amount is 200,000. So the loan term is going to be 5 years, and they're going to pay monthly about 4,055. So the total paid is going to be 243k. Paying 243k versus 271k, well, the choice is yours. Now, there's more to factor than just amounts you pay. When deciding whether to buy with cash or credit, the goal isn't just affordability, it's financial sustainability and long-term wealth. If I pay cash today, will I still be financially safe tomorrow? If you take out a loan, can you still pay the loan if you lose your income for 6 to 12 months? Paying cash may make sense if you still have 6 to 12 months in emergency fund after making the purchase. Never drain your emergency fund to pay cash. This is money for unexpected expenses. Life does happen. If you still have a very good cash flow afterwards, yes, cash could suit you. If your income is also regular or uncertain, cash route could suit you. If you're in a volatile job or form of employment, cash could suit you. If you generate a lot of cash, definitely cash would be ideal for you. If you have built an emergency fund, definitely cash will be a good option. Now, credit could suit you if your income is stable and predictable, and you can handle repayments even if income drops temporarily. So it could be for 6 to 12 months. If you don't have a lot of cash readily available, it could be an option to leverage on the lender's money. If you have better alternative investments, credit could also be an option. If you have built an emergency fund, definitely you should consider going for credit. Now, there is the cost of credit versus the return on investment. Compare the loan interest rate with the potential investment return. If the loan interest is higher than what your money could earn, cash is definitely better. If investment returns are higher than loan interest, credit may be smarter. Now, paying cash has pros. There's no loan repayment or interest to worry about. So you avoid paying extra money to the lender. In some cases, you're paying for something that could depreciate. You get ownership from day one. So the car or house is fully yours, no risk of repossession. It's a simpler process. There's no credit checks, no loan paperwork, and you can have a strong bargaining power. So sellers do generally love cash offers. It's faster and no financing risk. There's also possible discounts that you could have. Dealers sometimes give better prices for cash buyers. And you gain instant equity. You own the asset outright. And there's also the peace of mind. No lender, no foreclosure risk. However, there are also some cons. There's a large upfront cost. You're going to deplete cash that could have been used elsewhere. And then there's the opportunity cost. The money could earn more if invested instead of being tied up in a depreciating asset. And then there's an aspect of limited liquidity. You might run short on cash for other needs, and it's not easy if it's invested in a fixed asset. There is also a possibility of reduced tax benefits. So there could be possible interest deductions that you could benefit from. However, this is if the interest costs outweigh paying the taxman. Now, buying on credit also has got its pros and cons. Some of the pros are you get to spread out payments, so it's easier to manage your cash flow. You build a credit history. So if you do regular on-time payments, you're going to improve your credit score. And it also helps you to keep cash reserves. So you still have liquidity for emergencies or investments. There are also potential tax benefits. Interest payments may be tax deductible. And then there's also an aspect of inflation. Future payments may be made with cheaper money. That's if inflation is rising at a higher rate than interest rates. And you could be purchasing now an asset which you could appreciate. And this could offset the interest costs over time. However, there's an interest cost. You end up paying more than the sticker price. You could even be paying more than what you would have paid the taxman if you had the cash. You may pay 50 to 100% or even more over the life of the loan. And then there's also the aspect of depreciation per debt. Depreciating assets will lose value faster than you repay the loan. So the credit increase is in total cost of something that's actually worth less over time, typical of and common in cars. There's also the risk of repossession or foreclosure. So if you fall behind on your payments, you could lose your asset. Then there's the long-term debt commitment, something like from 5 to 30 years. Then there's also an aspect of market risk. If property values fall, you could owe more than the home is worth. If you have the cash, which won't tie you up to forgo other opportunities, then yeah. But if you do not have the cash, you can consider leveraging other people's cash. The advantages should outweigh the disadvantages in either route you choose. If you don't have the cash upfront, the key is to understand affordability, what you can safely borrow, and resilience, whether you could survive financial setbacks like a job loss or emergencies. You don't have to choose only cash or only credit. There are also balanced strategies. You can buy cheaper and pay cash. You can put a large deposit and borrow less. You can use credit whilst investing. You can use credit but below your maximum affordability. You can use credit but pay it off quicker. You can delay ownership and build up consistently. The smartest financial decision isn't about avoiding debt or chasing assets. It's about balancing growth, safety, and peace of mind. There's definitely no better choice, only personal priorities. Like and subscribe for more nuggets. Put your take in the comments. Nuggets about learn, build, and thrive.